Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most and do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
Welcome to The Wealth Flow. My guest today is Matt Hansen. Matt is a retired corporate executive who transitioned to full-time real estate investor. His investment portfolio includes over 2,000 units in multifamily apartments and many alternative asset classes. He focuses on helping people escape the volatility of the stock market by passively investing in real estate. Matt, welcome to the show.
Thanks for having me, Keith. Happy to be here.
Yeah. Why don't we start kind of with your background? You know, where did you grow up and what led you eventually to real estate?
Oh, that's a really good question. I live in rural Michigan. Yes. Somehow after going to university, I got a job at a Fortune 100 company, Dow Chemical, here in Midland. So it worked out well. I didn't have to leave the rural area. So I spent almost 33 years as in the corporate world, worked my way up to a global director, and then I retired about 2.5, almost 3 years ago now. So that's kind of my backstory. I grew up in a pharmacy, though. I grew up in a store. Imagine at 8, 9 years old when I just start working after school. I go to work at the drugstore and I would sweep the sidewalks, take care of the trash, wash the windows, and all that stuff. And then I was raised in a store. It's just kind of unusual growing up.
For sure.
And we also had a farm too. So when we had a farm that was an active farm with racehorses and things like that. So kind of unusual background. But then I got into business. I love business. I love marketing. And then I got my job at Dow and retired after 33 years. So that's my professional background.
Yeah. Yeah. And so then when did you start investing in real estate? Was it while you were still after? Yeah. My wife and I flipped our first house, and it wasn't even called flipping, like 30 years ago. It's before anybody did this. So we'd buy a house. Like I grew up on a farm, so I know how to do stuff, electric stuff and plumbing and all that. So we would buy a house. And again, this is like literally 30 some years ago. We'd live in it for a year. So I had long-term capital gains, to minimize my tax burden. So over the course of a year, we would just renovate the house and we would live in it and we'd renovate it. And at the end of the year, we'd sell it and make a big chunk of money. Then we'd buy another house. So we did that, probably 4 or 5 houses. Then we started having kids and we had a 1-year-old run around on plywood floors in one of the houses we were living in while renovating. Said, no, we need to stop doing this. So we stopped doing it for probably about 18 years. And the kids went off to college. Then I got back into it. And while I was renovating a house, I was listening to podcasts and I heard about this thing called passively investing in apartments, this syndication thing. Thinking, what? Hold it. No swinging a hammer, no doing these renovations. It's more of a business thing. You're buying a business. Well, I'm a business guy. I run $1 billion business unit. I can do this. So then I immediately stopped, finished flipping that house. I finished that house. And then I immediately, got into some training and syndications and stuff. And then just started doing deals. I passively invest quite a bit first to get to see what's going on as a limited partner in probably 5 or 6 deals. One of them was in San Antonio, where you live. Well, actually, 2 of them. Right. They did really well, by the way.
And then when I was comfortable, probably after 2 years, I'm still got my corporate gig. I started to get into running deals probably about 7 years ago. I'd actually run deals from LOI to close. So that's kind of how I got introduced. It was a podcast like 7 years ago that like, oh my gosh, so much easier. It's just, I can do everything from sitting in my office. So that's how I kind of discovered it.
That's a good perspective. I like the way that you put that. It's like buying a business, but that you don't really have to do the work if you're just basically putting an investment in and letting it do its thing with the operating partners. So
yes.
And so on your first couple deals, you mentioned doing those passively. Were those with the same couple sponsors, or did you kind of do one here with one sponsor and then another there, or what was your strategy there?
I separated. They were all different sponsors. So I wanted some diversity in my portfolio, even within real estate. And they were even in different states too. They're Memphis, Florida, Texas, in different locations in DFW, Dallas, Fort Worth, San Antonio. I got a deal in Waco. So I try to diversify. You're right. Good point. I didn't do everything in Dallas. I wanted to have it spread across in case there's a natural disaster or some economic thing happens unique to that. You want to be diversified in that. And that's what I did in my passive investing. But yeah, in different operators as well. And I made mistakes back then. I had one investment that it ended up making money, but not as much as it should have. And there was a capital call on it. And it was the operators. I knew one of the operators, and that operator happened to walk away and left it with the other two partners. The other two partners weren't as strong. I invested with the one person in it. So that's the thing. Make sure you vet all the partners you're investing with, not just the one you like. Check out the backgrounds of the others too, in case that person steps away and somebody else is running it. So there's a good pro tip for you from somebody that's kind of made a mistake there. Turned out okay. I still made, I think, 60,000 on it, but I should have made 100. So that was the downside of it all. But that's
right. Well, what are some other lessons that you learned along the way? You have a great perspective because you've invested, passively initially. And I'm sure you've learned things from your first deal moving forward. What are some of those additional lessons besides vetting, the entire team?
Put your minimum, because I had a lot of money to deploy. So I was deploying it at $100,000 here and here and there. And I should have been doing, and again, didn't know any better. I thought, I want to get this stuff deployed. I should have done the minimum investments with those individuals until I got to know them. Do the 50, the 75K or whatever. So that's my recommendation. If you're brand new, this isn't good as a capital raiser. I want people to write big checks to me. But even then, if somebody's newer, I'll say, you know what, just do the minimum. And then my next deal, you can go big and do $250,000 or whatever. But I just want to make sure I'm doing the right thing for the people I partner with. So I always recommend just do the minimum. If you're brand new to syndications and all that, that way you're more comfortable with it, and you're more comfortable with the operator or the person you're investing with to make sure, are they communicating effectively? Are you getting updates? Are they replying to you when you have questions? You can test those things out. So that's another recommendation. Do the minimum investment to begin with, and then ramp up as you get experience and you get your comfort level.
Yeah, I think that's good, and it kind of falls back to diversification. If you even if you have 100,000 to invest, if you spread that between two different sponsors, then there's less of an opportunity for things to not go well with the whole 100. So
yes, that's true.
And anything else? Any other lessons that you learned?
From being a limited partner, passive investor, really taught me what to do and what not to do when I became a syndicator myself and a general partner and I ran deals. So I think that was invaluable to find out, the timely response of people, making sure you're getting clear data, full transparency and everything. Sometimes operators aren't disclosing you want to make sure that you see everything, that they're giving you updates on a routine basis. I mean, these quarterly updates, if I got $100,000 in a deal, I want to hear from you once a month, not once a quarter. Right. I think that's just common type stuff. Mostly nowadays, most people do monthly, but just things like that you want to check references is pretty key to get a comfort level with what they're sharing, and you get a pretty good sense pretty quick, particularly after people talk to other people, talk to references is really important. I do that. I still passively invest. I have money in this 401k that I've rolled over to a self-directed IRA that I can't invest in my own deals. So I've got friends, lots of friends that I invest my money with, and I've vetted them over the years. Now these people I know 4, 5, 6 years. So it's a really safe and comfortable investment with them.
Yeah, and maybe Matt, if you don't mind talking a little bit about that, what you just mentioned, being able to roll over. So, you were with a company before, had the 401k, you've retired from that company, you've got this money still sitting in this account. And just so the listeners know, that's an option. You've got this money sitting there. And if you have the ability to roll it over, then it can certainly be invested in a real estate syndication.
One of the biggest secrets that Wall Street has, because they don't want you to know that you can do this. They want to keep all your money in the stock market. They get money off of your assets under management. Same thing with your financial advisor and all these individuals. They don't want you. Nobody has $1 billion budget like Wall Street and all the big firms that are, the stock brokering houses. They've got billions of dollars of budget advertising. They want you to keep your money there. We're doing passively investing in apartment complexes. We don't have that huge budget. So most people don't know about this and they don't promote it. They don't want you to know about it. That you can take your funds. So for example, I retired as a corporate executive, tons of money in a 401k. I didn't even know I could do this until about 8 years ago, but I had to wait until I had retired, because Fidelity wouldn't let me take it out because the agreement is you're employed at Dow. You need to keep your money with us. But once I retired, I broke that tie. Now I can take those monies and I'd roll them over tax-free and penalty-free to a self-directed IRA. Now I have control over it. Now I could invest in the real estate with that, or I can invest in stocks with those if I wanted to, but my whole point was getting it out of there. And that's when I just went crazy and had a blast. My wife and I investing all sorts of things like gold mine royalties, a startup road construction company that's developed a brand new product that can turn any soil into cement. It's incredible. It's been patented, and that's going to be worth $1 billion, that company. Some construction companies for modular building apartment complexes. And again, this is a guy I've known for probably 5 years. I buy my gold and silver through him. He has said, you know what? I'm going to buy this. We're going to build this company that will modularly make apartment complexes, because there's a shortage of housing in the US. So I'm invested in that one. So I've got lots of things like that I've invested in. Just being outside of that, you get in the network of individuals that are doing these things, you get access to things that people don't get. These are the ultra rich have access, like my gold mine royalty. That wasn't open to anybody else. One of my good friends was a CFO of a medical company I've been partnering with for years. Said, hey, I found this company. I think it's really good. So he developed, there's like 25 of us all put some money in. And so the company just did an offering. They just raised another $10 million. And it's eventually going to go public. I'm on the ground floor of this company. I paid next to nothing for these shares. And they've already tripled in value. And they're probably going to be maybe 100x actually when it goes fully public in the next year. But these are things you don't get exposed to because Wall Street doesn't want you to know. You need to be in a network of people like you, Keith. You do a great job with your podcast, getting people exposure to these types of opportunities that otherwise they would never know. Only the ultra rich know this in their little circles. So I love what you're doing here because you're helping people.
Yeah, well, thank you. Appreciate it. And couldn't do it without the guests, right? So I want to hear a little bit more about this product that turns, soil into concrete. What's the story behind that one?
It's incredible. So it's all technology based, and they'll take a powder that's delivered to the job site in a tote, powder, and they mix it. Well, first off, they do a forming. What's your local soil? If you're in Kentucky, they'll take a soil sample of wherever the road's going to be putting in. They're actually approved by the DOT in New Mexico, Texas, and I think Florida now. but they'll take samples of where you're going to put the road in or replace the road or wherever the local soil is. They'll make this powder that's complementary to it. Then you ship the powder there, then you mix it with water, and then it makes a permeable road surface. I mean, it's used for highways now, but also for parking lots, apartment complexes. The life of this is like 30 years because it's semi-permeable. Water goes through it. It never goes and expands and cracks. Like the roads are terrible in Michigan because of that. Or the heat down south. It doesn't have any of those issues at all. I mean, it's like a 30-year shelf life. And by the way, it only needs to be 3 inches thick. You don't have to do, this 2-foot thing. It's just phenomenal. Again, it's being approved. It's already been patented and all that stuff. It's being approved by DOT, Department of Transportations. It'll be $1 billion company. I own 3 shares of it. I mean, I bought the shares for $25,000. They're already worth $66,000. And I know that's going to be worth, sky's the limit. You think about the application in military use around the world. You can go out to the desert and put a road in. I mean, it's just incredible. Third world countries, it's such great things that this is going to do for the world once it gets out there completely. But so it's exciting stuff that, again, a friend of a friend knew about this. Actually, it was my son's girlfriend at the time's dad owns the company, and he was a friend of mine. Wow. And I said, yeah, I'll get on this. I'll throw some money at this. The upside is incredible. So just stuff like that. It's fun.
Yeah, that is neat. Any other interesting investments that you've made as far as these alternatives?
The gold mine royalty is pretty good. We're buying up property rights in Nevada, small. The company's small, like say 40, 50 acres. Then we bundle them all together in 1,000 acres, and then we sell them to a large company, the rights to it. So we get paid just for selling the rights and going out and doing the work and getting the rights to the property for gold mining. But then we get a small percentage. If the company we sell these rights to, if they find gold on it, we get residuals, a fraction of % of it, which would be significant. Yeah. And that company is going to be going public hopefully in the next year or so, but they've just raised another $10 million like in no time at all, because what they're doing is really, really good. So those are the types of things that we're doing. I'm trying to think if got any others. Oh, a lot of land entitlement stuff. Got a friend that's got property down in Texas across from the new Tesla plant that I'm an investor in. Yeah. It's 140 acres that it's a gold mine. We bought it before that was all done. So there's a shortage of housing of like 10,000 houses there. That's, we've got land entitlement space. We own the property. And then we can either sell it to a developer or develop it ourselves or subdivide it. So it's already doubled in value based on after we bought it. So just things like that are really exciting, significant. I'm used to putting money on the stock market, letting it grow over 30 years, and I got a big pile of money, but it took 30 years to do that. With the things I'm doing now, I can do what I did in 30 years, probably in 5 years, accumulate that type of wealth with the knowledge and the connections that I have now.
That's great. And tell me a little bit about maybe how you have made those connections. I think that's important as well. I know for me, becoming parts of different masterminds, that kind of thing, has really kind of exposed me to a lot of these alternative investments that most people just don't know about. But I'm sure there's maybe some similarities, but maybe a different way that you've gone about it.
That's actually it, Keith. It is. It's through these high-priced masterminds. I mean, the threshold to get into some of these groups is really, really high. And they're already pre-vetted. Everybody's got to be a multimillionaire and all of these criteria. So I put myself in these environments with people that are like me or way beyond me. So yeah, that's really way. I don't know how you would do it other than that. Unless you have an uncle or an aunt or a boss that's in those networks, it's hard to get in that network of individuals. And I've been in some of these for 5, 6 years, 7 years. So these are close personal friends of mine. So when they do have a gold mine royalty, he only reached out to 5 people or 10 people. And I was one of those in the same thing. Right. So that's a really good question. How do you get in that circle unless you're ultra wealthy in a family office where you're being pitched to these things all the time? It's hard to get in that network because it's a small network of high net worth individuals. And again, that wasn't a public offering. All those things I mentioned, only the land entitlement was a public offering. all those you had to personally know the person to even get the invite. And they're very selective of who they're going to allow come in because they don't want they're not going to take your last $100,000. You got to be a high net worth to begin with. That's a really good question. I don't know how you do that other than joining masterminds. Do you?
I don't know. I mean, you're going to get a little bit of exposure on, certain podcasts, but aside from that, no, I mean, that doesn't get you in the room. And I think the masterminds really get you in the room with the right people. And ideally you are, worth the least out of everybody else in there because you only have one way to go and that's up. Right. So what about, you mentioned high cost masterminds, and we don't have to go into how much they are, but a lot of people hear that and they think to themselves, well, is that worth it? Would you say that they've paid for themselves so far? I know the answer.
I'll tell you. I'm going to give you numbers. I have one mastermind. I think I paid $35,000 to join. My profit on that investment was over $400,000 over the course of the last 5 years. You tell me, was that $35,000 worth it?
That's for sure.
Now you got to engage. You can't just join and be a lump on a log. I mean, I participate. Like when I join a mastermind, I'll reach out to look to see who are the most active individuals in that group, and I'll book calls with them. I'll get a 15, 30-minute call with them. Say, hey, tell me how you did this. Tell me, is there anything I could do to help you? And that's how I got into deals so quickly, is because I'm a corporate executive. I run $1 billion business unit. I know numbers. I know profit and loss. I know how to lead people. I know how to get stuff done. So I met, one of my first deals, I met somebody 2 weeks later. I was running their deals for them. From LOI to close, I ran syndications because I knew how to run a business. I knew how to get people, herd the cats, if you will. If you've run a syndication, it's herding cats. You've got your lending broker. You've got your insurance company. You've got your legal team. You've got your property management team. You've got all these moving parts, and you got to get everybody doing thing to close on a $40 million apartment in 90 days. It is a lot of work. I don't do that work anymore. I primarily focus on raising capital and marketing and things like that with my partners. But it takes a skill set, but you got to put yourself out there. And that's important. If I would have joined those groups and done nothing, I probably wouldn't be getting these offers to come in and partner with people on deals. But because I engaged, put myself out there and said, hey, I'm willing to help you out. And then they discovered my background, said, oh, can you run these deals for us? Because I got 5 of them here. And I don't know. I could really use help somebody that knows how to manage people and processes and systems. And I came in and did that. So think about what you can do. What's your value proposition as an individual, even as a passive investor, to let them know that, maybe I can help you out with your marketing. Maybe I can help you out with this. You can always, there's always that bartering thing you can do. Because there's some deals that I put no money into it, but I did a whole bunch of work for them, and I get a share of the equity in the deal because I did all the whole marketing campaign and attracted the investors for it and things like that.
Okay. Yeah, that's great advice. Let's maybe talk a little bit about some of the multifamily investments that you've done. And where have you and your company purchased, and what type of investment are you looking for?
The typical value add Class B, usually 200 plus unit apartment complex in the Southwest. Texas, Florida, Arizona. I do have some stuff in Memphis that I bought years ago that it's still doing great. We did a cash out refinance and gave 60% of our investors money back, and we're still running that deal. But Florida, Texas, Arizona, probably the hottest market. And then everybody's looking. As a result, I've not done a deal since December, and this is
really
right now. Because we're so selective, the interest rates are up. Insurance is really killing us in pretty much all states now. So the dynamics have changed. So I really haven't done a deal in almost 10 months now, because I'm not going to do a deal just to do, and it's got to be a home run before I invest or have anybody else invest in. So for that reason, the market's really tough right now, and I think we all feel the pain on this. So that's
for sure. Let's maybe talk a little bit about that pain and, what what do you see happening or unfolding over, say, the next 2 years, 3 years, 5 years? What's going to happen with the commercial lending and the commercial just the multifamily environment in general?
Well, I'll get my magic 8-ball out here and I'll make some decisions for you, because that's about as good as it gets. Matt's worldview, it's going to be tough, I think, for the next year or so. It will turn around. There's a shortage of housing in the U.S. I know in Florida, I think in 2021, 1 in 7, the houses bought in Florida in 2021, 1 in 7 houses in Florida was bought by an investor that year. I don't know what 2022 stats were, but I remember I was living in Florida at the time and we were looking to do stuff down there. And because people were trying to wholesale houses, and I've got friends that are big wholesalers down there, and they're selling them to Wall Street left and right. Isn't that incredible? So 1 in 7 houses that were purchased in 2021 in Florida, again, this is from secondhand information, was by an investor. So that means there's a shortage of people. People have to rent. Not everybody wants to rent a house. They want to rent. So we know the growth rate for multifamily is going to continue to be strong. As the population age, they don't want to have to manage their house. They want to move into something. Younger people want to have the flexibility of not having a mortgage and being tied here. They want to be mobile. You can work virtual now. Why do I want to have a house here when I can go and live in Cancun for a month, in San Diego for a month, and Mykonos, Greece for a month? So the whole change in the what do they call it? The transitioning or transitory, whatever the word is there. People want to live where they want to live and work where they want to work. That's changed the world a lot. So I say the demand for multifamily continue to be strong. Now, the economics of buying one right now is just terrible. Interest rates are so high. Insurance rates are so high. It's hard to make a deal profitable. So I say we got another year and a half, and things will start loosening up. The economy hopefully will get a little stronger and interest rates come down, and you'll see more deal flow, if you will. But that's Matt's opinion, whether it happens or not. I know right now it's not good because we analyze hundreds of deals, and nothing looks like it's good enough. We want to put an investor in ourselves. That's my take.
Okay. Yeah. Makes sense.
What is yours? I want to hear yours, Keith. What do you think?
I think you're right. I think eventually it's gonna turn. But I think there's still going to be a delta between ask price and where it makes sense to buy. Probably I would say we have at least another year of that. I think that pricing will start to get more realistic. As we kind of settle to this new reality. But obviously I don't have a crystal ball either. So, but I would hope that, I'd hope that interest rates at some point, in the next year and a half start to turn, downwards. I was kind of hoping that was going to happen in Q4 of this year. But I think that was a little unrealistic. So.
I was too. I was hoping by the end of this year it was going to turn it, and it doesn't look like it's going to. I'm with you.
Exactly. The Fed seems to be saying, hold tight. It's still going to be a little bit. So anyway, and then maybe tell us a little bit more about. So you mentioned that you haven't bought anything yet this year. Are you entertaining or looking at any other type of investment, or are you mainly still focused on multifamily?
I was just talking to one of my friends. I had a conference call with one of my friends, and we were talking about that too. He does stuff in California, and he's still doing deals, but he's doing smaller niche stuff in like San Diego, which is one of my favorite cities in the U.S. He's buying like 20, 30 unit apartments, and he's making a killing at it because nobody's going after that market. Now I've shared. I shouldn't have done that. Anyway, but it's a tough market. He lives there. He's a native. You don't want to live in Michigan and do that stuff in California. You need to be boots on the ground and really know that market. He's been there forever. But I would say that that it's just stuff like that that's going to really work in the future. I think it's going to be a while before we see that come back for us.
Yeah, I think so too. Yeah, I've seen, just in talking with several multifamily guys, a lot of them have pivoted a little bit. I mean, they're still looking. They still got their ear to the ground to try to find another deal. But Some of them have moved into oil and gas. Some of them have started with some build to rent stuff, which I thought's been kind of interesting to me. Just there's different things out there just to try to keep people busy, right? So
right. Yeah, I guess I'm sorry I didn't answer your question, but yeah. Yes, the bottom line is yes. I'm looking at should I be doing storage units? Should I be doing mobile home parks? I got a good friend that's doing phenomenal mobile home parks, but again, that market's being saturated because us multifamily people are saying, "Oh, this market's terrible. We're switching over there." ATMs, for some reason, ATMs are still a thing. With blockchain coming, I don't know, but people are investing in ATMs. No offense to the ATM investors, but I think that's crazy. I haven't used an ATM in years, but I guess the markets those are located in, it's a good investment. But Keith, I'm looking like, okay, do I need to do another asset class type thing? And it probably will have to. I'm going to take the rest of the year off and kind of relax. But next year, I think in first quarter, I need to take a good hard look and say, okay, multifamily, maybe another year. I've got an investor database that has been waiting for me to bring something else to them, and I don't have anything. I may have to pivot like a lot of people are. Yes, I agree.
Yeah.
That was a really good question. A loaded question.
Right. Curious. All right. We like mobile home parks, myself. So that's kind of what our focus has been recently. We've done multifamily as well, but what about maybe some of the lessons that you've learned, as being, one of the principles within the deal? You mentioned learning some things as to how you wouldn't want to do things, or maybe some communication stuff. But what are some of the things that you've learned as you've taken on different deals that you could share with the audience?
I guess really running a deal, it's having clear expectations, setting clear expectations with the team, and the same thing with investors. You want to make sure they really know all the details of why you bought the property. What's the exit strategy? What is the plan? And things, you have to pivot. Things happen. Hurricanes occur in Florida, roofs get ripped off, things like that. But we have insurance for that. And then we also have insurance for lost income for that. But there's those types of things. I think the key is being transparent and making sure you're communicating effectively of the possible scenarios that could occur. I think that's one of them. And then just running the deal, having clear roles and responsibilities. Again, it's the corporate thing. Who does what? So nothing falls through the cracks. It's really important. Okay, if you're managing this portion of the project, that needs to be done. And there needs to be milestones and checkpoints and key performance indicators and those types of things, metrics to make sure that things are staying on track. And that's what's great. If you have a business background, it's directly relatable to buying an apartment complex. You're buying a business. That's all it is. You're buying a business. So having a construction background really isn't applicable. It's really, do you know how to run a business? Because that's what it is. Do you know how to vet? I did mergers and acquisitions. We would buy out businesses when I worked for Dow, and then I would evaluate who stays, who goes, who has the best mousetrap, who has the best processes and systems. And that's what it's all about. These apartments, you take it over, you got to take a look at what isn't running well. Oh, you know what? It looks like they're doing a really good job of, getting renewals, but they're doing a terrible job on maintenance, and people aren't being taken. They have to wait a week for something to get fixed. It's all those little things you want to look at to make sure you're making a good experience for your residents, which results in a great experience for your investors, because those people pay your bills. I think that's the big lesson is run it like a business. You got to think like a business person when you're doing apartment complexes or anything like this. It's all business. It's all numbers with ones and zeros.
Yeah. What about the property management? Do you have your property management vertically integrated, or is it specific to the location? What does that look like?
Yeah, it's all specific to the location, because I partner with people in all sorts of different states, and that is challenging because you're at the mercy of a property manager, and there's a natural conflict there because their income is based on net income. They're rewarded based on the net or the gross profitability. How much are you bringing in? They don't care about the net and all the expenses but you as an investor, you do care about those. So there is not there's no way around this. And the world needs to change when it comes to property management companies. They should be rewarded based on the net, not the gross, in my opinion.
Yeah, I agree.
That's a huge thing. How are you going to change that? So I do have friends that once you get to, you're in Houston and you've got 2,000 units, you bring that in-house. You have your own team. Property management is the most thankless job, the most important job, though, for managing an apartment complex. But I would never want to have to do it. It's tough. You're evicting people. You're dealing with all these issues every day. But once you get to that size, you usually bring that in-house and you still have all the same challenges, but you're aligned with the goals. So I do like to invest with somebody that's got a vertically integrated property management company. It is because they're going to control what's going on. They're not going to have the property management doing something that's good for them, but maybe not good for your residents. Yeah, that's a good point.
Yeah. What about, let me see, tell me a little bit about any type of maybe tax advantages that there are for investing in some of these alternative assets, whether it be, real estate or anything else. What have you seen throughout your journey as, both an investor and, one of the principals?
For alternative investment, I don't think anything really beats I will say real estate's really good. Oil and gas a little bit better. I have not invested, but I've got one of my friends that does a lot of that, and he's been offered me to go into a couple of those, but I just never had funds at the time. I had things deployed on other projects. But I think the oil and gas is the only thing that kind of beats real estate in terms of depreciation and paper losses, bonus depreciation and cost segregations, and all these crazy words that you need to talk to your CPA about. But basically, if you're in a position to take advantage of those, it's really powerful. In multifamily is really good for that. The Class B multifamily that we're renovating them. So we have a big paper loss on those. They don't send out distributions for the first year or so sometimes because it takes a while as people move out, we renovate units and bump up rent. So it takes a longer time to do that. But from a tax standpoint, it's very rewarding. Now, some of my other things that I'm doing, like the business startups and all, I don't have the big tax advantage, but I'm probably going to 10x or the roads. I'm probably going to 100x my investment in that. I really expect that to happen in the next 5 years. So it outweighs it, but I do a lot of real estate for the depreciation, so I can knock off my other income. And again, talk to your CPA on that. So you need to make sure. Good point, Keith. You need to know what you're investing in, how it's going to help you. I know my startup investments, I don't get no great tax advantage. But in my real estate, I do, and I know in oil and gas, you do. So make sure you know the benefits, the side benefits of just not investing, but also how does it save you money in other ways? And that's really important to know as well. So good, glad you brought that up because they're not all equal. They're not all equal. And even deals within real estate, if you get a value add that needs a lot of renovations and that's going to have maybe a higher depreciation than a Class A apartment that's already done, and there's the upside is really just cash flow. When that's sold, your margins may not be as huge as this value add because you're not improving it that much. But man, the cash flow day one, you're getting paid money, and if that's your strategy, your personal investment strategy, then that's what you should invest in. Don't invest in these other ones where you may have to wait a year, 2 years to get a dividend, if you will, or distribution. So know yourself first, then select the investment that matches it.
Yeah, no, that's great advice, and I think you're exactly right. I mean, some are going to cash flow more at the beginning, and others, the first couple quarters, you're probably not going to see distributions, maybe even beyond that, depending on the deal. Talked to a couple guys on development deals, and a lot of those you're not seeing any distributions in the beginning. It's all about the exit at the end. So, but there's something out there for everybody. Maybe, you could speak a little bit to, you mentioned, being a corporate executive and kind of, investing in the stock market, and then, these alternative investments and how you could grow your money in a lot shorter time frame. Can you give maybe some examples of the type of growth and the different things that you can see from these alternative investments?
Yeah, the big difference is when you're investing in a stock, you're investing in apartment buildings. You're buying stocks in that apartment, by the way, as well. But if you're investing in a company, you're getting dividends. The exit plan there isn't to sell the company and then you share in the profit. You don't share in the profits. You get a percentage, a small percentage, but you're never going to make it a big, huge. Like I had a property sell. I made $172,000 in one deal last year. $172K. What type of investment are you going to do in the stock market that's going to do that? Unless you're a day trader and doing something speculative and doing commodities or Forex or something crazy like that, which takes a whole new skill set and 10 years of experience. And there's a handful of people that can do that. You simply cannot do that in the stock market as a passive investor. You can't make $172K on 100. Well, that one, I think I had zero money into that deal. I just worked the deal. I ran it from LOI to close. I did all the marketing. I did all the herding all the cats. My reward is $172K. But where else can you do that? You can't do that. Even our passive investors 2x their money. So if you put 100 in, you got 200. And we did that in 24 months. Again, This is pre-COVID. It doesn't happen now. Yeah. Where can you do that in the stock market? And it's backed by real estate. This was a real estate investment. It was an apartment complex. It's never going to go to zero. My stocks could go to zero, but this is a physical asset. It's insured, by the way. So that's the thing. You can't even really. It's apples and oranges. Now it's more speculative. It's quicker. You do need to have a skill set. You do need to select the right deals. You need to do your due diligence on the operator. Do these people really know what they're doing? Do they know the market well? Do they have a good exit strategy? Do they have a good development plan for the property? But it can be done, but it's not all passive. I mean, it truly is passive. You write a check and you're done. But your research before you write that check is so important to make sure it's aligned with your goals. But I mean, that's an example of there's no way you can do that in the stock market. And the same thing with all my other investments. That one mastermind yielded $400K, a little over $400K for me because I had the knowledge to know what to do and how to do it. And a lot of that was limited passive investing that I did. And I love those. I like the passive stuff. I do even more passive than I do active at this point, just because I've got the funds in my 401k that I'm still deploying. And as it turns, so that I have money sitting, I get $200K back from something in my 401k, my self-directed IRA. I can't take that money out with paying taxes and penalties because I'm not 59 and a half. So I just take that money and I put it in another friend's deal. And I'm a new development deal in South Carolina. I've got a new development deal there with one of my friends. I put another chunk of money in there. I got a bunch of money back from one of my investments, still in my self-directed IRA bucket. Don't have to pay taxes or penalties. Then I invested in that deal, that's an 18-month, no profit. I don't get anything for 18 months, but we're going to sell this development. It's a new subdivision on a golf course, the $1 million homes minimum. I will double my money. I'm quite certain. We've already getting offers from contractors to buy out the whole subdivision, but we're kind of sitting on it for a while. We want to get the roads in and stuff like that. But where else can you double your money in 18 months? And it's pretty safe. It's a piece of real estate sitting there in a great location, high net worth. The houses in the neighborhood are all $1 million plus. Yeah, it's incredible. So that's a couple examples of how you can do this. You can double your money. Again, there is risk involved, and it takes some knowledge and expertise. Sure. That's why you need to watch Keith's show. This show will help you, educate you.
It's a great plug, Matt. I appreciate it. Well, let's maybe talk a little bit about what you do when you're not investing in real estate. What do you do for fun, Matt?
Actually, I do consulting work for a capital raising company. So that's because I haven't done a deal in 10 months. So I got bored and I was part of a mastermind group. And I said, I got some time, I can help. So now I actually coach other people how to raise capital now. So I do that. But I still do my quarterly vacations. Once a quarter, my wife and I go on vacation. Usually even with our adult kids, we'll come with us and we'll do a quarterly vacation somewhere in the Caribbean, or we're going to California, and we're going to next month. And then in first quarter, we're going to the Caribbean for a week and stuff like that. Ride bicycle a lot. I love cycling. Yeah. And reading lots of books. I love books. And there's nowhere else you can get expertise without actually having to do it. And then just applying it. That's really, really powerful. But I would say that the traveling I'm a social media, or not social media, a pop culture junkie. I love movies. I love TV shows.
Okay.
I'm going to admit it. I love TV shows. I love movies. I love that stuff. It gives an escapism. It's fun. I enjoy it. So that's kind of
yeah. Cool. All right. Sounds good. Well, I want to ask you two other questions, but before I get there, maybe if you could tell everybody how they can find out more about you if they want to invest in one of your deals once you get them, and want to be able to stay in contact for when you find something.
Thanks. Yeah, just go to Hansen Holdings with an S at the end.com, and Keith will have it in the show notes. You can just scroll down HansenHoldings.com. And there's a bunch of information about what we do, how we help you, some stuff on self-directed IRAs. If you haven't done that, make sure you're aware of it, because you don't know, your situation can change. You switch jobs or something like that, or you retire, or if you just come into money too, you may want to invest. So it's important to get educated first. We have a lot of educational stuff out there.
Yeah. Okay. Fantastic. And got two questions that I ask every guest, and the first one is, what advice you might give to somebody in the audience who's just starting their investment journey?
I would just say homework. You've got to be passionate about this stuff. I know it's a passive investment, but you have to educate yourself on it. You've got to be able to look at, a pitch deck, if you will, or investor presentation, and understand what is the exit strategy. What is the growth development for this? If they're saying, "Oh, we're gonna grow 10x, 10% every year," no, that's not realistic. 2 or 3%, maybe even less than that. If you see crazy numbers, run the other way. Use your common sense too. You will, and I see things cross my decks all the time. I'm a venture capitalist in a syndicate. I'm marketed to every single week. I get offers coming, and some of them I'll look at and like, "Oh my gosh, I would never invest in this." So it's upon you. You need to be educated so you know at first blush whether something is good or not, and then deep drill into it. And if you get a trusted advisor, I think people that I work with, they'll bring deals to me to look for somebody else to invest in. And I will say, sure, I'll look through it and say, "Oh, here's why I wouldn't invest this," or "Here's the reasons why I would." So certainly consult with somebody that knows that. Again, I'm not a financial advisor. Don't play one on TV or anything else, but I'll give you my 2 cents. And most importantly, if there's a red flag in the deal, and I did have somebody bring me a deal that said it was in the middle of Pennsylvania with a town with a population of 10,000 people. And it was a 100-unit apartment complex. And there's one employer in town. I said, if that employer goes away, that apartment complex is empty and it's not coming back. Do not invest in that deal. But just stuff like that. Consult with other people. We're happy to share. We want to make sure you make a good decision. So I think that's my biggest tip, is educate yourself and consult with others if you're not comfortable making the decision.
I think it's great advice, Matt. How about a book recommendation?
Yes. I love Simon Sinek. Anything this guy puts out, he's kind of he was a marketing VP or whatever. And now he's really a thought leader about how to live a better life holistically. He's got a book called The Infinite Game. It's about, you should gamify everything, and it shouldn't be about the destination. It should be about the journey. But the book that I recommend everybody read is really Start With Why. Start with why. Like, this applies to everybody. Why are you doing what you're doing? Why is Keith doing what he's doing? Why am I doing what I'm doing? And you need to figure out what that is for yourself, because that allows you to decide, even when it comes back to investing, like, you know what? I do want to retire when I'm 52 years old. So these are the things that I need to be doing doing to get there. So really evaluate your life. Like, why are you doing the things that you do? And are they aligned? And if it's not aligned, why are you doing it? And I think a lot of us don't do that self-reflection. I'm big into meditation and yoga. I'm a little woo-woo. I know that. But this applies to anybody. What are you doing and why are you doing it? And it's really important to take a look at that in all facets of your life, not just investing. It really works for investing, but even day to day. I always make it a priority to get on my little bicycle and ride every other day. Today it's 50 degrees. I'm going to go out for a ride after this. Not pleasant, but that is who I am. That is my why. I need to get out and exercise. I need to do that. So Start with Why, Simon Sinek. Check it out. It's worth it no matter where you're at in your life. It's worth taking that self-evaluation. So I strongly recommend it.
All right. It's been a little while since I've read that one, so I may have to put that one back on my list here. All right, yes. Matt. Well, listen, I really appreciated the time that we've had here together, and I know that you've provided a ton of value to the audience. And so I just really want to thank you for coming on The Wealth Flow.
It's absolutely my pleasure, Keith. And thanks for what you're doing of putting this great information out for people. You're providing a needed service. So thank you.
All right. Thanks, Matt.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.